stop what you're doing. Seriously, if you own any major tech stock right now, you might be sitting on a zero-margin digital powder keg. It's like building a skyscraper on a fault line. But while a lot of retail investors are completely panicking over a potential AI bubble, there's one cybersecurity giant quietly capitalizing on all this chaos. Last week, I actually ran Tenable through 5 strict fundamental valuation models, plus Warren Buffett's and Peter Lynch's legendary investing checklists, and honestly, what I found completely shocked me. Because we all have that exact same fear, right? That nagging dread of buying into a tech stock that looks shiny on the outside but is secretly just bleeding cash because of outdated, vulnerable tech. Well, by the end of this explainer, you're going to know exactly if Tenable's massive Q1 2026 earnings surge makes it a hidden Buffett buy or just a classic Lynch value trap. I promise you a clear, actionable framework you can literally steal to evaluate this company today. But before we break down the intrinsic value and jump into those 5 financial models, I need you to look at this staggering number right here, 86%. This single number is exactly why that fear of buying a vulnerable tech stock is so incredibly real right now. According to Tenable's newly released Cloud and AI Security Risk Report for 2026, 86% of organizations have installed third-party code packages that contain critical severity vulnerabilities. Think about that for a second. That means nearly 9 out of 10 companies you interact with are practically leaving their front doors wide open. As companies just rush blindly to adopt AI, they're inheriting cyber risks exponentially faster than human teams can even patch them. And this isn't just some abstract IT problem, guys. It's a massive financial liability for the broader market. But, on the flip side, it is the exact catalyst driving Tenable's insane revenue right now.
All right, let's dive right into this. Here's our roadmap for today. First, we'll look at the AI exposure gap. Second, Tenable's AI-powered solution. Third, their Q1 2026 financial highlights. Fourth, their strong cash and capital. And finally, the Wall Street outlook.
Starting with Section 1, the AI exposure gap.
The core of this whole issue is captured perfectly in this quote straight from Tenable's own research. They say organizations face a zero-margin AI exposure gap as they inherit cyber risks faster than they can address them. So what does this actually mean? It means engineering velocity, driven by this massive AI adoption, plugging in third-party code left and right, and just the sheer massive scale of the cloud has completely outpaced human-led risk management. The bad guys are literally moving at the speed of AI. And if you're stuck defending at the speed of humans, well, you've already lost the game.
Let's see how this builds into some highly specific, frankly terrifying vulnerabilities. The data shows that 65% of organizations are exposing their high-value assets through forgotten cloud credentials. We're talking about overprivileged identities, where, say, a former employee or some random forgotten piece of software literally holds the keys to the kingdom. And these risks, they don't just live in one neat little silo. They span across applications, identities, AI agents, and core data. But you want to know the most dangerous part? Security teams largely lack the visibility to even know these vulnerabilities exist. It's just a massive, glaring blind spot.
Which brings us to a foundational concept we really need to nail down right now: exposure management. As defined here, it's the practice of identifying, evaluating, and prioritizing risks across all entry points. Look, this isn't just about patching traditional software bugs anymore. It is about fixing cloud misconfigurations, identity security weaknesses, and those totally unknown shadow assets created by AI and messy third-party supply chains. This whole comprehensive puzzle, that is the exact problem Tenable built its business to solve.
Moving right along to Section 2, Tenable's AI-powered solution.
This graphic brilliantly illustrates their approach. You've got Tenable One and their newly introduced Hexa AI orchestration engine acting as a fully agentic AI engine. They aren't just scanning and saying, hey, here's a problem. Hexa AI actually automates the security workflows. It turns raw exposure intelligence into concrete action at absolute machine speed. It's fighting fire with fire, or in this case, fighting AI-driven threats with AI-driven remediation.
To put a human face on all this tech, look at this quote from Tenable's co-CEO, Mark Thurmond. He calls out a heightened level of urgency across our customers. Listen, this isn't just hypothetical, pie-in-the-sky tech talk. This represents a very real panic happening right now in the C-suite of major global enterprises. Customers are actively picking up the phone, demanding solutions to prepare for this incoming wave of vulnerabilities introduced by AI models. The demand is absolutely surging. And when those panicked executives go looking for a solution, where exactly do they turn? Take a look at this Forrester Wave chart from late 2025. Tenable is positioned up there as the one clear leader in unified vulnerability management. In fact, Their internal data notes that 4 times as many customers choose Tenable over the competition. No contest. They've established this incredibly dominant market position at the exact moment the market's need for their product is hitting an all-time high. Talk about timing.
Okay, Section 3, Q1 2026 financial highlights. So how does all that market dominance translate to the balance sheet? The numbers point to some really strong growth. Tenable reported $262.1 million in revenue. That is a solid 9.6% year-over-year increase. Their non-GAAP earnings per share jumped significantly to 47 cents, comfortably beating estimates. But I really want you to notice those bottom 2 bullet points. 406 new enterprise platform customers and 43 net new 6-figure customers. This aggressive adoption rate of their Tenable One platform is exactly what's driving revenue well past expectations and locking in these major lucrative enterprise accounts.
Now, what's really fascinating about this slide is the sheer operational leverage. Just compare Q1 2025 to Q1 2026. They went from a negative 7.4% GAAP operating margin to a positive 3.3% in just a single year. And if we look at it on a non-GAAP basis, their operating margin expanded to a really impressive 23.6%. Think about what that means. As Tenable's revenue grows, their profitability is accelerating even faster. Why? Because of strict cost discipline and, ironically enough, the very same AI-driven efficiencies they sell to their own customers.
Moving to Section 4, strong cash and capital.
All of that margin expansion translates into this: $88.6 million. That is the unlevered free cash flow figure Tenable managed to generate in just this single quarter. It showcases some seriously significant cash conversion.
Breaking that number down a bit, we see $88 million in net cash from operating activities. Plus, they're sitting on this massive backlog of future contracted revenue, what we call remaining performance obligations, at over $1.01 billion. And that backlog is growing at nearly 15% year over year. Because they have this robust cash generation engine humming along, management was actually able to repurchase 6.1 million shares for $130 million. You guys know this, but when a company steps up and buys back its own stock like that, it's a massive flashing signal of confidence from management regarding the durability of their future cash flows.
And finally, Section 5, Wall Street outlook.
Well, Tenable management certainly gave Wall Street a big reason to be optimistic this quarter. They went ahead and raised their full-year 2026 guidance completely across the board. They're now expecting up to $1.078 billion in revenue. They raised their EPS guidance to a midpoint of $1.94, and they project unlevered free cash flow to approach nearly $300 million for the year. And management made it crystal clear. They fully expect AI-driven sales productivity and automation to further support this significant margin expansion going forward.
However, we have to look at this objectively, so let's impartially structure Wall Street's consensus. The bull case? They absolutely love the expanding portfolio, the new pricing models, and how perfectly positioned Tenable is to capitalize on the fast revenue growth driven by these AI security tools. But we have to acknowledge the bear case too, because they have some totally valid concerns. Tenable relies heavily on channel partners. Their varied architecture approach can create some pretty heavy expense burdens, and ultimately, at their current valuation, they absolutely have to strictly maintain these high-growth metrics. Any slip-up, any missed quarter could weigh incredibly heavily on investor sentiment.
Synthesizing all of that data, as of right now, 16 analysts have issued a consensus buy rating for Tenable, with an average price target of $29.19. Just keep in mind, this target is simply an aggregate projection based on their financial models, earnings growth, and the overall industry outlook we've been walking through today.
And that leaves us with a final, slightly provocative question to ponder. With this AI exposure gap literally widening every single day and hackers moving at absolute machine speed, will Tenable's raised 2026 financial guidance and the rollout of their Hexa AI engine truly be enough to outpace the evolving dangers and stay ahead of the fierce competition? The data definitely suggests they have the momentum, but as we all know, the cybersecurity war is never truly won. Thank you so much for joining me on this explainer today. Keep learning, keep questioning, and I'll catch you next time.